Question 1. Which of the following is the primary advantage of purchasing a fixed annuity over a variable annuity? A. Fixed annuities offer greater potential for investment returns due to market fluctuations. B. Fixed annuities provide a guaranteed minimum interest rate, ensuring a stable income. C. Fixed annuities have higher flexibility for withdrawal options and more riders. D. Fixed annuities are subject to higher surrender charges in the first few years. Answer: B. Fixed annuities provide a guaranteed minimum interest rate, ensuring a stable income. Explanation: fixed annuities are designed to provide a guaranteed interest rate, offering predictable and stable income to the policyholder. Unlike variable annuities, which can fluctuate with market conditions, fixed annuities ensure that the income stream remains constant and are typically less risky. While variable annuities have the potential for higher returns due to market performance, they also carry the risk of losses. Option A is incorrect because variable annuities are the products that offer returns tied to market fluctuations. Option C is incorrect as variable annuities generally offer more flexibility with investment options, not fixed annuities. Option D is incorrect because surrender charges tend to be similar across both fixed and variable annuities, depending on the contract terms, but fixed annuities do not necessarily have higher surrender charges. Question 2. Mr. Adams is a 65-year-old retiree who wants to ensure that he has a guaranteed income stream for the rest of his life. He has an immediate need for income but also wishes to protect his spouse in the event of his passing. What type of annuity would best suit Mr. Adams' needs? A. Fixed indexed annuity with a cost of living adjustment cover. B. Immediate annuity with a joint and survivor option. C. Deferred variable annuity with a death benefit rider. D. Hybrid annuity with a guaranteed minimum withdrawal benefit. Answer: B. Immediate annuity with a joint and survivor option. Explanation: an immediate annuity with a joint and survivor option is the most appropriate choice for Mr. Adams. Immediate annuities begin payouts immediately after the contract is initiated, which aligns with his need for immediate income. The joint and survivor option ensures that his spouse will continue to receive income after his passing, fulfilling his desire to protect her financially. Option is incorrect because a fixed indexed annuity, while it provides some income, is not as immediate in its payouts and does not necessarily provide the guaranteed lifetime income that Mr. Adams is seeking. Option C is incorrect because a deferred variable annuity does not provide immediate income and also carries investment risk which may not align with Mr. Adams' needs. Option D is incorrect because a hybrid annuity with a GMWB is typically more focused on income withdrawal guarantees, not immediate income for a specific duration. Question 3. Which of the following is a key regulatory requirement under the New Jersey Annuity Suitability Rule when recommending an annuity product to a senior customer? A. The product must be recommended solely based on the customer's current financial status without considering future income needs. B. The agent must perform a comprehensive needs analysis that includes consideration of the customer's age, financial goals, and risk tolerance. C. The agent may recommend products that offer the highest commission, regardless of suitability. D. The product must offer a flexible premium option to accommodate the customer's changing financial situation. Answer: B. The agent must perform a comprehensive needs analysis that includes consideration of the customer's age, financial goals, and risk tolerance. Explanation: the New Jersey Annuity Suitability Rule requires that agents thoroughly assess the financial situation of the client, including their age, financial goals, and risk tolerance, to ensure the annuity product recommended is suitable for their specific needs. This rule is in place to protect senior customers from making unsuitable investments in annuities that do not align with their financial goals or risk appetite. Option is incorrect because the suitability rule requires a broader consideration of factors, not just current financial status, but future income needs as well. Option C is incorrect because recommending products based solely on commission without regard for suitability is a violation of the rule and ethical standards. Option D is incorrect because while some customers may benefit from flexible premium options, this is not a requirement for suitability and does not align directly with the regulatory focus on meeting the customer's overall financial needs. These questions are designed to test advanced understanding of annuities and the regulatory framework, providing students with deeper insights into both theoretical and practical aspects of annuity planning and sales practices. Question 4. Which of the following statements is true regarding the tax treatment of annuities under New Jersey law? A. Both the principal and earnings in a qualified annuity are taxed as ordinary income when withdrawn. B. Earnings in a non-qualified annuity are taxed as capital gains when withdrawn. C. The tax deferral benefit only applies to the accumulation phase in a non-qualified annuity. D. All withdrawals from annuities are subject to a 10% federal penalty tax if taken before age 591, regardless of the type of annuity. Answer A. Both the principal and earnings in a qualified annuity are taxed as ordinary income when withdrawn. Explanation. In a qualified annuity, the principal and earnings are both tax deferred during the accumulation phase. However, when withdrawals are made, both the principal and earnings are taxed as ordinary income as they were made with pre-tax dollars, similar to qualified retirement accounts. Option B is incorrect because earnings in a non-qualified annuity are taxed as ordinary income, not capital gains. Option C is incorrect because tax deferral applies during both the accumulation and distribution phases of a non-qualified annuity, not just the accumulation phase. Option D is partially correct in that a 10% penalty applies to early withdrawals from most annuities before age 591, but it is not true that all annuities are subject to this penalty. The penalty does not apply to certain exceptions like annuitization. Question 5. Which of the following is a characteristic of a fixed-indexed annuity? A. It offers a guaranteed rate of return based on the performance of a specific stock index without any risk of loss. B. The interest credited to the annuity is based on the performance of a stock market index, but it is capped at a maximum return. C. It allows the policyholder to select individual securities for investment, similar to a variable annuity. D. It guarantees both a minimum return and a maximum return, providing a fixed income stream for life. Answer B. The interest credited to the annuity is based on the performance of a stock market index, but it is capped at a maximum return. Explanation. A fixed indexed annuity links its interest crediting to the performance of a stock market index, such as the S&P 500. However, the return is typically capped, meaning there is a maximum percentage of return that can be credited to the annuity, regardless of how well the index performs. The annuity offers some protection from market losses, but also limits the upside potential. Option is incorrect because the interest rate is not guaranteed and is subject to caps, and there may be some market risk due to index performance. Option C is incorrect because in a FIA, the policyholder does not select individual investments, unlike a variable annuity. Option D is incorrect because while there may be a minimum guaranteed return in a FIA, it does not provide a fixed income stream for life unless it is converted into an immediate annuity or a similar product. Question 6. What is the primary difference between a fixed annuity and a variable annuity in terms of investment risk? A. Fixed annuities provide returns based on the performance of a portfolio of individual stocks, while variable annuities guarantee a fixed interest rate. B. Fixed annuities are low-risk products with a guaranteed interest rate, while variable annuities expose the policyholder to market risk through investment in sub-accounts. C. Fixed annuities offer higher potential returns than variable annuities, but with less risk. D. Fixed annuities require the policyholder to select sub-accounts, while variable annuities provide guaranteed fixed payments. Answer B. Fixed annuities are low-risk products with a guaranteed interest rate, while variable annuities expose the policyholder to market risk through investment in sub-accounts. Explanation. The key difference is that fixed annuities offer guaranteed returns with no exposure to market risk, meaning the insurance company assumes the investment risk. In contrast, variable annuities allow the policyholder to allocate funds into various sub-accounts, which are often invested in stocks or bonds, thus exposing the policyholder to market risk and the potential for both gains and losses. Option is incorrect because fixed annuities do not invest in individual stocks and do not offer stock market performance-based returns. Option C is incorrect because variable annuities generally offer higher potential returns, but they also involve greater risk. Option D is incorrect because fixed annuities do not require the selection of sub-accounts, which is a characteristic of variable annuities. Question 7. Which of the following is a potential disadvantage of purchasing an annuity with a long surrender period? A. It allows the policyholder to withdraw up to 100% of their premium without penalty after a certain period. B. The policyholder may face significant surrender charges if they withdraw funds before the surrender period ends. C. The annuity may not provide guaranteed income if the policyholder lives longer than expected. D. The policyholder will be able to change the beneficiary designation without any penalty or restrictions. Answer. B. The policyholder may face significant surrender charges if they withdraw funds before the surrender period ends. Explanation. An annuity with a long surrender period typically carries surrender charges if the policyholder withdraws funds within that period. These charges can be significant and are designed to discourage early withdrawals, which is a disadvantage for policyholders who may need access to their funds sooner than expected. Option A is incorrect because the policyholder is typically not allowed to withdraw 100% of their premium without penalty, especially during the surrender period. Option C is incorrect because the disadvantage described here refers to liquidity, not longevity. Annuities can provide lifetime income regardless of the policyholder's lifespan. Option D is incorrect because the ability to change the beneficiary may still be subject to contractual terms, and penalties typically apply to withdrawals, not beneficiary changes. Question 8. What does the 1035 exchange rule allow an annuity policyholder to do? A. It allows the policyholder to withdraw funds from an annuity without incurring any taxes or penalties. B. It allows the policyholder to exchange an existing annuity for another annuity or life insurance policy without triggering a taxable event. C. It allows the policyholder to convert a fixed annuity into a variable annuity without paying surrender charges. D. It allows the policyholder to transfer an annuity to a beneficiary without incurring death benefits taxation. Answer: B. It allows the policyholder to exchange an existing annuity for another annuity or life insurance policy without triggering a taxable event. Explanation: the 1035 exchange rule under the Internal Revenue Code allows policyholders to exchange one life insurance policy or annuity for another without incurring a taxable event. This can be beneficial if the policyholder wants to adjust their annuity product to better fit their financial needs without triggering taxes on gains. Option A is incorrect because the 1035 exchange rule does not allow for withdrawals without penalties or taxes. It only applies to exchanges. Option C is incorrect because a 1035 exchange does not allow for the conversion between a fixed and a variable annuity. It allows for exchanges between certain types of contracts. Option D is incorrect because the 1035 exchange does not affect the taxation of death benefits. Question 9. Which of the following is an advantage of purchasing a hybrid annuity product? A. It provides the same returns as a fixed annuity but with no market risk. B. It allows for both fixed and variable components, offering a balance of guaranteed income and growth potential. C. It provides a higher payout rate compared to both fixed and variable annuities. D. It guarantees a fixed interest rate during both the accumulation and payout phases. Answer: B. It allows for both fixed and variable components, offering a balance of guaranteed income and growth potential. Explanation: a hybrid annuity combines features of both fixed and variable annuities, providing policyholders with the security of a guaranteed minimum income like a fixed annuity, while also offering the opportunity for growth through market-based investments like a variable annuity. This balance allows for flexibility and increased potential returns while maintaining some protection from market volatility. Option A is incorrect because hybrid annuities expose the policyholder to some market risk due to the variable component. Option C is incorrect because hybrid annuities do not necessarily offer higher payouts than fixed or variable annuities, that they provide a combination of features. Option D is incorrect because hybrid annuities typically have a fixed rate during the accumulation phase, but not during the payout phase, depending on the chosen structure. These additional questions aim to challenge advanced students by testing their understanding of key annuity concepts, regulatory frameworks, and specific financial strategies within the New Jersey Annuities exam syllabus. Question 10. Which of the following is an example of a violation of the suitability rule in selling annuities under New Jersey insurance regulations? A. Recommending a fixed indexed annuity to a client with a long-term investment horizon and a high risk tolerance. B. Suggesting a variable annuity to a client with a low risk tolerance and a short investment horizon. C. Offering an immediate annuity to a client who is seeking a guaranteed lifetime income. D. Selling a fixed annuity to a client who is close to retirement age and needs guaranteed income. Answer: B. Suggesting a variable annuity to a client with a low risk tolerance and a short investment horizon. Explanation: under the suitability rule, insurance agents are required to recommend annuity products that align with the financial goals, risk tolerance, and time horizon of the client. A variable annuity is not suitable for a client with a low risk tolerance and a short-term investment horizon because it is subject to market risk and its value can fluctuate. Option A is correct because recommending a fixed indexed annuity to a client with a high risk tolerance is appropriate as it offers growth potential tied to a stock index. Option C is correct because recommending an immediate annuity for guaranteed lifetime income is suitable. Option D is correct because a fixed annuity may be an appropriate recommendation for a client nearing retirement who seeks predictable income. Question 11. What is the primary difference between a qualified and a non-qualified annuity? A. Qualified annuities are purchased with after-tax dollars, while non-qualified annuities are purchased with pre-tax dollars. B. Qualified annuities are subject to income taxes only on the earnings when withdrawn, while non-qualified annuities are taxed on both the principal and earnings. C. Qualified annuities are purchased with pre-tax dollars and are subject to strict IRS rules, while non-qualified annuities are purchased with after-tax dollars and have more flexible contribution limits. D. Qualified annuities are only available to corporate investors, while non-qualified annuities are available to individual investors. Answer. C. Qualified annuities are purchased with pre-tax dollars and are subject to strict IRS rules, while non-qualified annuities are purchased with after-tax dollars and have more flexible contribution limits. Explanation. Qualified annuities are typically purchased through retirement accounts like IRAs or 401ks with pre-tax dollars. These annuities are subject to strict IRS rules regarding contributions, withdrawals, and required minimum distribution (RMDS). In contrast, non-qualified annuities are purchased with after-tax dollars and do not have the same contribution limits, although they are still subject to tax on earnings when withdrawn. Option is incorrect because qualified annuities are purchased with pre-tax dollars, not after-tax dollars. Option B is incorrect because non-qualified annuities are taxed only on the earnings when withdrawn, not on both the principal and earnings. Option D is incorrect because both qualified and non-qualified annuities are available to individual investors. Question 12. Which of the following best describes the accumulation phase of an annuity? A. The phase during which the policyholder receives periodic income payments from the insurer. B. The period during which the annuity's value grows based on the investment choices made by the policyholder. C. The phase when the policyholder must start taking required minimum distribution or MDS from the annuity. D. The period during which the policyholder is no longer able to make additional premium payments. Answer. B. The period during which the annuity's value grows based on the investment choices made by the policyholder. Explanation. The accumulation phase is the period when the policyholder is making contributions, premiums, to the annuity, and the annuity's value increases either by interest credits for fixed annuities or by the performance of investment sub-accounts for variable annuities. The goal during this phase is to grow the value of the annuity until the policyholder is ready to begin receiving income. Option A refers to the payout phase, not the accumulation phase. Option C refers to required minimum distribution (RMDS), which apply after the accumulation phase, typically starting when the policyholder reaches age 73. Option D is incorrect because additional contributions can still be made during the accumulation phase unless the annuity specifies otherwise. Question 13. Which of the following is a potential disadvantage of purchasing an annuity with a long surrender period? A. The policyholder may have to pay a higher premium than for other types of annuities. B. The policyholder may face a lower income stream than in a non-qualified annuity. C. The policyholder may be subject to significant surrender charges if funds are withdrawn before the surrender period ends. D. The annuity will lose its tax-deferred status after the surrender period ends. Answer. C. The policyholder may be subject to significant surrender charges if funds are withdrawn before the surrender period ends. Explanation. An annuity with a long surrender period means that if the policyholder decides to withdraw funds before the period ends, they may face surrender charges. These charges can reduce the amount of the withdrawal and are a common disadvantage for clients who might need access to their funds earlier than planned. Option A is incorrect because the premium paid is typically not higher just because the surrender period is long. Option B is incorrect because the income stream is more dependent on the annuity type and payout options, not the surrender period. Option D is incorrect because the tax-deferred status of the annuity remains intact regardless of the surrender period. Question 14. What is the purpose of the free look period in an annuity contract? A. It allows the policyholder to change the beneficiary designation at any time without penalty. B. It provides the policyholder with a specified number of days to review the contract and cancel it for a full refund of premiums paid. C. It guarantees the policyholder the right to cancel the contract for any reason within 30 days after the annuity starts paying income. D. It allows the policyholder to transfer ownership of the annuity without incurring a taxable event. Answer. B. It provides the policyholder with a specified number of days to review the contract and cancel it for a full refund of premiums paid. Explanation: the free look period is a consumer protection feature that allows the policyholder to review the terms of the annuity contract after signing it and cancel it for a full refund of premiums paid within a specified number of days, typically 1030 days. This gives the policyholder an opportunity to reconsider their purchase without financial penalty. Option A is incorrect because changing the beneficiary designation is not related to the free look period. Option C is incorrect because the free look period is not tied specifically to income payments. Option D is incorrect because transferring ownership of an annuity is not part of the free look period provisions. Question 15. Which of the following would be the most appropriate recommendation for a client looking to avoid probate on their annuity? A. Purchase a life insurance policy in addition to the annuity. B. Select a revocable living trust as the beneficiary of the annuity. C. Choose a primary beneficiary who is a family member under the age of 18. D. Purchase an annuity with an immediate payout option. Answer: B. Select a revocable living trust as the beneficiary of the annuity. Explanation: designating a revocable living trust as the beneficiary of an annuity allows the proceeds to pass directly to the trust and avoid probate, which is the court-supervised process of distributing assets after death. This is an effective way to bypass probate and ensure the assets are managed according to the trust's terms. Option is incorrect because purchasing life insurance does not necessarily avoid probate for an annuity. Option C is incorrect because designating a minor beneficiary may complicate the process as a court-appointed guardian may be required. Option D is incorrect because selecting an immediate payout option does not avoid probate. Question 16. Which of the following is true regarding the taxation of annuity withdrawals in New Jersey? A. All withdrawals from annuities are tax-free. B. Only the earnings portion of an annuity withdrawal is subject to income tax. C. Both the principal and earnings are taxed at the capital gains rate. D. Annuity withdrawals are always subject to a 10% federal penalty tax. Answer: B. Only the earnings portion of an annuity withdrawal is subject to income tax. Explanation: in New Jersey, as in most states, only the earnings portion of an annuity withdrawal is subject to income tax, while the principal, the amount originally invested, is not taxed. This is because the premiums were paid with after-tax dollars, but earnings accumulate on a tax-deferred basis. Option A is incorrect because annuity withdrawals are subject to tax except for the return of principal. Option C is incorrect because the tax on annuity earnings is taxed as ordinary income, not at the capital gains rate. Option D is incorrect because the 10% federal penalty tax only applies to early withdrawals made before the age of 591 and it is not automatically applied to all annuity withdrawals. This penalty is in addition to regular income taxes. Question 17. Which of the following is a feature of a variable annuity? A. It provides a fixed rate of return, regardless of market conditions. B. The policyholder can choose from a selection of investment options, typically including mutual funds. C. The premium paid is always guaranteed to be returned to the policyholder. D. It has no risk of loss to the policyholder's principal investment. Correct answer: B. The policyholder can choose from a selection of investment options, typically including mutual funds. Explanation: a variable annuity allows the policyholder to choose from a variety of investment options, usually mutual funds or sub-accounts, which can include stocks, bonds, or other securities. The performance of these investments will determine the return on the annuity, meaning the value can fluctuate based on market conditions. Option is incorrect because a fixed rate of return is a characteristic of a fixed annuity, not a variable annuity. Option C is incorrect because the principal in a variable annuity is not guaranteed to be returned as it is subject to market performance. Option D is incorrect because a variable annuity involves market risk, meaning the principal could lose value. Question 18. Which of the following would be an example of an annuity rider? A. A clause that guarantees a minimum payout amount for a fixed period. B. A section of the contract that outlines the terms of surrender charges. C. A provision that automatically renews the contract after a certain period. D. A rule that specifies the interest rate credited to the annuity. Answer A. A clause that guarantees a minimum payout amount for a fixed period. Explanation: an annuity rider is an optional addition to an annuity contract that provides additional benefits or features beyond the standard terms. A guaranteed minimum payout rider ensures the policyholder will receive at least a certain amount of income over a fixed period, regardless of the annuity's investment performance. Option B is incorrect because surrender charges are part of the contract's basic terms, not a rider. Option C is incorrect because automatic contract renewal is not typically considered a rider, it would be part of the terms of the annuity. Option D is incorrect because the interest rate is typically part of the annuity's main provisions, not an optional rider. Question 19. What is the primary purpose of the death benefit rider on a variable annuity? A. To ensure the annuity pays a minimum amount of income to the beneficiary. B. To allow the beneficiary to receive the value of the annuity at the time of the policyholder's death, even if the account value is less than the premiums paid. C. To provide a fixed income to the beneficiary for a set number of years. D. To provide tax advantages for the beneficiary upon receiving the death benefit. Answer: B. To allow the beneficiary to receive the value of the annuity at the time of the policyholder's death, even if the account value is less than the premiums paid. Explanation: the death benefit rider on a variable annuity ensures that the beneficiary receives at least the total premiums paid into the annuity or the account value, whichever is greater, if the policyholder dies before annuitization. This rider provides a safety net for the beneficiary even if the account value has declined due to market losses. Option A is incorrect because the death benefit typically provides the greater of premiums paid or account value, not a guaranteed income. Option C is incorrect because the death benefit rider does not provide an income stream, it provides a lump sum payout. Option D is incorrect because the tax treatment of the death benefit is generally based on the beneficiary's tax situation and does not provide specific tax advantages due to the rider. Question 20. In New Jersey, what is the maximum surrender charge that can be assessed on a fixed annuity during the first 10 years? A. 1%, B. 3%, C. 7%, D. 10%. Answer: C. 7%. Explanation: in New Jersey, the maximum surrender charge that can be assessed on a fixed annuity during the first 10 years is typically 7%, though this can vary depending on the annuity product and the insurer's specific terms. This charge applies if the policyholder withdraws funds before the end of the surrender period. Option A is incorrect because surrender charges are generally higher than 1%. Option B is incorrect because 3% is lower than the typical maximum surrender charge. Option D is incorrect because 10% is higher than what is usually allowed by New Jersey regulations for fixed annuities. Question 21. Which of the following would be considered a tax-deferred benefit of an annuity? A. The annuity's earnings are taxed as capital gains when withdrawn. B. The premiums paid into the annuity are tax-deductible in the year of purchase. C. The income payments received from the annuity are not taxable. D. The annuity grows without being taxed until withdrawals are made. Answer: D. The annuity grows without being taxed until withdrawals are made. Explanation: a key feature of tax-deferred annuities is that the earnings accumulate without being taxed until the policyholder begins making withdrawals, typically in retirement. This allows the annuity to grow faster than a taxable investment because the earnings are not taxed yearly. Option is incorrect because the earnings from an annuity are taxed as ordinary income, not capital gains. Option B is incorrect because premiums for a non-qualified annuity are not tax-deductible. Option C is incorrect because income payments from the annuity are taxable when withdrawn. Question 22. Which of the following factors can affect the value of a variable annuity? A. The performance of the underlying investments chosen by the policyholder. B. The interest rate offered by the insurer at the time of purchase. C. The annuity's fixed income guarantee. D. The length of the surrender period. Answer A. The performance of the underlying investments chosen by the policyholder. Explanation: the value of a variable annuity is directly impacted by the performance of the underlying investments, such as mutual funds or stocks, that the policyholder selects. If these investments perform well, the annuity value will increase. If they perform poorly, the value can decrease. Option B is incorrect because the interest rate offered by the insurer applies to fixed annuities, not variable annuities. Option C is incorrect because the fixed income guarantee applies to fixed annuities, not variable annuities, and does not affect the value of a variable annuity. Option D is incorrect because the length of the surrender period affects penalties for early withdrawals, not the value of the annuity itself. Question 23. Which of the following is true about a fixed annuity? A. The policyholder assumes all of the investment risk. B. The annuity provides variable returns based on the performance of the market. C. The annuity provides a guaranteed fixed income stream for life. D. The annuity grows based on the performance of the stock market. Answer: C. The annuity provides a guaranteed fixed income stream for life. Explanation. A fixed annuity provides the policyholder with a guaranteed fixed income stream regardless of market performance for a set period or for life. This option eliminates the investment risk for the policyholder. Option A is incorrect because the insurer assumes the investment risk in a fixed annuity. Option B is incorrect because fixed annuities provide predictable, fixed returns, not variable returns. Option D is incorrect because a fixed annuity does not rely on stock market performance. Question 24. In New Jersey, which of the following is generally the primary purpose of purchasing an annuity? A. To provide an immediate income stream. B. To preserve wealth for future generations. C. To avoid paying state income taxes on investment income. D. To receive a guaranteed return on investment that exceeds inflation. Answer A. To provide an immediate income stream. Explanation. Annuities are often purchased to provide a steady income stream either immediately or in the future, particularly in retirement. They can be a reliable way to ensure that the policyholder will not outlive their savings. Option B is incorrect because while annuities can preserve wealth, they are more commonly used to generate income. Option C is incorrect because while annuities may offer tax-deferred growth, their primary purpose is income, not tax avoidance. Option D is incorrect because annuities often provide a fixed return that may not keep pace with inflation. Question 25. What is the exclusion ratio in the context of annuities? A. The percentage of an annuity's earnings that is taxable when withdrawn. B. The percentage of the annuity's purchase price that will be returned to the annuitant tax-free. C. The percentage of annuity withdrawals that are taxed as capital gains. D. The amount of interest that can be earned in an annuity before the policyholder is taxed. Answer. B. The percentage of the annuity's purchase price that will be returned to the annuitant tax-free. Explanation. The exclusion ratio is the portion of each annuity payment that is considered a return of principal and therefore not subject to tax. This ratio is calculated based on the original investment, purchase price, and the expected number of payments. Option A is incorrect because the exclusion ratio relates to the return of principal, not earnings. Option C is incorrect because annuity earnings are taxed as ordinary income, not as capital gains. Option D is incorrect because the exclusion ratio does not concern interest earned. It deals with the portion of the annuity payment that is not taxable. Question 26. Which of the following is true about a life-only annuity? A. It guarantees income payments for a set period of time. B. It guarantees income for the life of the annuitant, but payments stop upon death. C. It allows the annuitant to choose how long they will receive payments. D. It guarantees a fixed lump sum payout to the beneficiary after death. Answer. B. It guarantees income for the life of the annuitant, but payments stop upon death. Explanation. A life-only annuity provides income for the lifetime of the annuitant, but payments cease upon their death. This type of annuity does not provide any death benefit to the beneficiary. Option A is incorrect because life-only annuities are not limited to a set period that they continue for as long as the annuitant is alive. Option C is incorrect because life-only annuities do not allow the annuitant to choose the duration of payments. Only the life of the annuitant is guaranteed. Option D is incorrect because there is no death benefit in a life-only annuity. Question 27. What is a common disadvantage of a variable annuity? A. The annuity guarantees a fixed return regardless of market performance. B. The policyholder bears the investment risk, which could result in loss of principal. C. The annuity provides guaranteed lifetime income with no market risk. D. The annuity has a tax-free growth option, but it limits the amount of contributions. Answer. B. The policyholder bears the investment risk, which could result in loss of principal. Explanation. In a variable annuity, the policyholder chooses from a variety of investments and the value of the annuity depends on the performance of those investments. This means the policyholder bears the investment risk and there is the potential for a loss of principal. Option A is incorrect because the returns in a variable annuity are not fixed. They depend on the performance of the chosen investments. Option C is incorrect because variable annuities involve market risk and do not guarantee lifetime income without risk. Option D is incorrect because variable annuities do not limit contributions but do involve investment risk. Question 28. Which of the following is typically a feature of a fixed annuity? A. The premium is invested in the stock market and subject to market risk. B. The annuity payments are guaranteed and fixed regardless of economic conditions. C. The income payments fluctuate depending on the performance of underlying investments. D. The annuity's value is based on the performance of mutual funds selected by the policyholder. Answer: B. The annuity payments are guaranteed and fixed, regardless of economic conditions. Explanation: a fixed annuity provides guaranteed fixed payments to the policyholder regardless of market performance or economic conditions. This ensures a predictable income stream for the annuitant. Option A is incorrect because fixed annuities are not invested in the stock market and are not subject to market risk. Option C is incorrect because income payments from fixed annuities do not fluctuate. They are fixed. Option D is incorrect because fixed annuities do not rely on the performance of mutual funds or other investments chosen by the policyholder. Question 29. What is a typical characteristic of an immediate annuity? The annuitant begins receiving payments shortly after the premium is paid. B. The annuitant has the option to select from multiple investment options. C. The annuitant chooses a lump sum payout at the time of purchase. D. The annuitant must wait for a specified accumulation period before receiving payments. Answer A. The annuitant begins receiving payments shortly after the premium is paid. Explanation: an immediate annuity starts paying out income immediately or within a short period after the premium is paid, often within one payment cycle. This is in contrast to deferred annuities, which have an accumulation phase before payments begin. Option B is incorrect because immediate annuities do not allow the annuitant to choose investments. Option C is incorrect because immediate annuities provide regular income payments, not a lump sum payout. Option D is incorrect because immediate annuities start paying income immediately or very shortly after the premium is paid, without an accumulation period. Question 30. Which of the following annuity types allows for the greatest potential for growth based on the performance of underlying investments? A. Fixed annuity. B. Immediate annuity. C. Variable annuity. D. Indexed annuity. Answer: C. Variable annuity. Explanation: a variable annuity offers the greatest potential for growth because it allows the policyholder to invest in a variety of investment options, typically including stocks and mutual funds, whose performance determines the return on the annuity. This means the value of the annuity can increase significantly depending on the performance of the selected investments. Option A is incorrect because fixed annuities provide predictable, fixed returns and do not offer growth based on market performance. Option B is incorrect because immediate annuities provide regular income payments, not growth based on investments. Option D is incorrect because indexed annuities are tied to the performance of the stock index, but they usually have a cap on growth potential.